Khemka from Motilal Oswal Financial Services. He's joining us to talk about markets and how to plan and how to navigate your investment journey amid all the turbulence and oscillation. Siddhartha, thank you so much for taking time out and joining us today.
My pleasure, Karuna. Thanks for having me on your show.
Likewise, Nath, it's been an eventful week for the markets. Of course, the biggest theme or the biggest development that everybody across the globe was tracking was the new COVID variant, as the situation has been slowly panning out, evolving. It's still very much under observation. But yes, today we've seen a massive selling on the Lal Street, perhaps because of fresh cases of the new variant, which have been detected in India as well. But Siddharth, just to start open the conversation, I would like to understand what should we make of the market moves this week. Yes, net, we are very much in the positive. Benchmark indices have closed with a gain of 1%, both for the Sensex and the Nifty for the week gone by. But overall, how should we look at what is happening in the market right now?
So, Karuna, if you look at the market setup, we have now we are now sitting on a huge bull run post last year's pandemic fall, when the market went into an uncertain territory. From there, we have quite recovered quite a lot. So maybe also in terms of the economic perspective, in terms of the corporate earnings, which gave a strong visibility to the market, and on back of that, we saw the kind of sharp run up. When you are sitting on such high gains, basically any negative news flows becomes a kind of risk to you. And that is where we saw, even before the third wave or the new variant of the COVID came in, we had some of the global brokerages downgrading the India equity weightage, suggesting trimming off, some suggesting reducing weightage to India, some suggesting to book it's a good time to book profits. And we saw that post that the FI outflows began unabated. We saw that becoming even more aggressive after the news of the new variant of the COVID, that is the Omicron con that came out. And as I said, uh, on the positive side, the earnings outlook is pretty strong. Economic recovery is on a steady path, but at such high valuations, even if a small risk of a deviation from the course because of a new wave of a pandemic, I think it's pretty time to be cautious, at least for the short-term traders, given the volatility that is likely to ensure in the way. And if you look at what FIs are doing, basically they are trimming their portfolios to bring it in line with their model portfolios. The weightages that they have globally across various countries, India had sharply outperformed the emerging space, and on back of that, the India weightage in the portfolios had gone much above their comfort zone. So some bit of profit booking will continue for some more time, but that doesn't mean that the long term story of India has turned bad.
Okay. But you were talking about FII selling. So I just want to understand what do you think is the factors, is the reason why this continued selling by foreign institutional investors is taking place? Why is it?
So, Karuna, I was just explaining, when as a portfolio manager, if you have a certain weightage in a particular stock and it goes on to more than double, you either take a call that even at these valuations, you are okay to have that concentrated exposure to one particular stock or one particular region, in this case of FIs, or you trim it down to bring down it to closer to your model portfolio weightage. We have seen in the last couple of quarters, some of the weightages assigned to India has definitely been upgraded, increased to match the growth potential that India is showing. We are among the fastest growing emerging markets globally, and to match that, the weightages have increased. But the current weightage, because of the outperformance in India, are way too higher, even compared to the increased weightage on the model portfolio. So it is kind of trimming your overexposure to India. That is what is happening on back of the profits that you are sitting on, and on back of the overvaluation that Indian markets had run up to.
Okay, understand. Siddharth, like I was flagging off, many of our viewers who tune in week after week for the show are retail investors and they ask us a host of questions as well. You were talking about volatility that could be the flavor for the next few weeks as well. So, one of our viewers is asking us, can we expect downside of the market further? Is there any steam left in the market? So, while you did flag off that one should expect volatility, is that it, or could there be further correction as well?
So that's a bit difficult to answer right now. If you ask me, fundamentally there could be some more downside to the market in terms of valuations. Even after the current fall of 7-8% from the peak, we are now closer to about 20 and half times P on a 1 year forward earnings, and the long term average would be about 18 and a half to 19 times forward earnings. So we can still expect another 4 to 5% correction that would bring the valuations in the comfort zone. They have already come down, as I said, from about 24 times to now about 20 times, which is bringing them in much comfort zone. But there could be still about room for 4 to 5% correction from here on, but it may not happen in one go. it, we need to see how the new COVID thing progresses. We have been hearing a lot of comments from the WHO, from the US president, from the vaccine manufacturers, the pharma companies, from Indian government. But really, it's a difficult call for an equity analyst to talk about the science behind the COVID. Uh, if the impact is not that much on the economy, I think we will recover much faster, as we had seen post the first pandemic when we had seen the lockdown much stricter uh, compared to the second wave, where the COVID impact was much higher, but the economic lockdowns were much controlled and much better managed by the governments. So I think the volatility has definitely gone up. We have seen the volatility, the VIX index going up sharply only after last year's Feb. We saw that VIX seeing such kind of increase on a month-on-month basis in the last few days. But I think bulk of it we have already absorbed, and a little bit of more volatility. As a long-term investor, we need to sit tight. If the stocks that you're holding has a good fundamental, has a good management, has a long-term business viability, I don't think there is any reason to panic. The volatility is mainly going to impact short-term traders, and it's given a good opportunity for long-term investors to add on dips. That would be my view on the markets.
So, what kind of stocks or themes should one add up on at this juncture? Where do you see, good fundamentals at good valuation?
Yeah, that's a good question. Where do you see the growth coming in, or the fundamentals as well as valuations being comfortable? So IT as a sector we like very much from a near term as well as from a long term perspective. The sector has seen strong positive tailwinds. They are sitting on record order books, and the IT spend globally, spending on digital, on cloud, this has gone up tremendously. Every company in the world now wants to have a digital presence, and that is something is helping the IT space. So, and within that space, the mid cap ITs have sharply outperformed. There's still a lot of value left in the large cap. So you can look at companies like an Infosys, a Tech Mahindra, which we prefer within the IT space. Followed by that, we like the consumer theme. That is another theme which is not done well in the recent times. They generally trade at a premium valuation, but they've underperformed in the recent times, and that's a space that acts as a defensive bet to the current volatility. Beyond that, there's a capex theme that we like for the next 1 year. We believe that while the government capex continues to be pretty strong, the private capex cycle is picking up, and that is on back of the strong structural growth in the demand that we are seeing, which is leading to higher capacity utilization. So sectors that we like within that space is cement, capital goods, real estate are some of the space that we like, that we believe can do well. Beyond that, there are two sectors, kind of a contra view there. One is banking, and the second is auto. Both are facing headwinds. Banking, in terms of the credit cycle, and a new wave of pandemic and lockdown could impact the credit cycle again. While the auto sector is consistently being impacted by supply chain issues, the global issues with regards to the semiconductor and chip availability, and both the sectors have underperformed. But that is a space that we believe post the near term, if things start turning around with news flows of improving availability, improving supply chain for the auto sector, things could be pretty good once that happens. And for banking, I think bulk of the pain and pressure is behind. And from here on, once the economic growth picks up, banking as a sector should do well.
Okay. In fact, we were getting a lot of questions with respect to Nifty Bank and why the banking space overall is underperforming. So you've already flagged off that for us. But yes, I mean, let me just take a quick glance at more questions that are trickling in. Uh, any divestment stocks or PSUs that you like, divestment candidates or PSU candidates that you like at this juncture? This is also a recurring question because there was, until a few weeks back, a lot of interest in many of these PSUs as well, which have seen a very solid run up.
So, Karuna, if you look at the PSUs, bulk of them are kind of closely linked to the economic. So, mostly the PSUs, or as you say, the public sector enterprises are core industrial companies. For example, they mostly you will find them in the banking space, which are to fund the industrial growth in the country. You have in the metal space, power space, defense, some of the shipping, oil and gas space. So these are all the core sector industries. And as I said, the economic growth, the economic outlook that has improved after the pandemic with the government stimulus package and the lower interest rate environment, which has helped boost the demand. So the entire space looks very attractive, and that's a space where a lot of value is there. You have the comfort of the management, which is the government. Balance sheets of a lot of them are pretty stable if you leave aside the PSU banks. But apart from that, most of the companies, public sector enterprises, have decent balance sheets. And the only matter of question is whether they will be able to participate in the growth in the economy. And I think that is a fair interest in the market for PSUs, given that the market was trading at a high valuation of more than 20 times. And here is a space which gives a lot of comfort, is in the value space. A lot of companies have 3, 4, 5% of dividend yield, and a lot of them, say for example, metals, power, and they saw good demand because of the global improvement in the metal prices, the improvement in the domestic demand for power. So these companies started doing well. So I think our view on the PSUs or the PSEs is definitely positive, but we have to be very selective. There are a lot of companies which are not that efficient players. So you take some of the market leaders in the respective space, for example, a Coal India, a Power Grid, or some players in the defense space, the Bharat Electronics, and especially in the banking space, we like three banks: the SBI, Union Bank, and Bank of Baroda. So this is space which we like. Now, coming to disinvestment theme, that is a theme we believe will take time gradually. The government is putting in a lot of efforts for some of the divestment, trying to make rules and trying to do changes in the businesses so that they are able to divest. Say, for example, some of the companies where the land issues are there, where the agreements are there with the government, the subsidiaries are there where they are remerging or divesting, and so they're trying to do a lot. I think among the top picks there could be you have the BPCL, which is on top of the block, which can really do well if it is divested, and some of the metal companies which are on the divestment list. I think that if goes through, can really do well.
I want to circle back once again to what you said about volatility, which could sustain for some time now. So, at a time like this, would it be prudent to just look at blue chip companies, companies that are cash rich, companies that are more strong in terms of fundamentals and balance sheet, rather than perhaps indulging in small and mid cap indices, small and mid cap stocks?
So, Karuna, you rightly highlighted. in a period of economic volatility, it's always prudent to look at blue chips, basically market leaders who have strong balance sheet, who have the strength to bear the brunt of the economic vagaries, especially when you don't know what kind of impact that come. So definitely it makes sense to look at some of the large caps. And if you look at from a stock market perspective, in the last 1.5 years, mid caps and small caps have sharply outperformed large caps. And that is where even when I was talking about the IT stocks, I think a lot of value is still there in large caps compared to mid and small caps, which had run up sharply. So
Hmm.
our preference would be that you tilt your portfolio more towards large caps. At the same time, one cannot ignore mid and small cap companies in India, given that lot of you can say niche segments are there which are witnessing strong growth, but there is hardly any large company present. Say for example, a specialty chemicals, the largest company will not come among the top 100 companies. So how do you play that? You have some of the textile players which are again small, some of the real estate players which are again are mostly mid-sized players. So some of the retail companies are mid-sized players. So there are a lot of niche segments. Another segment which was doing well, say for example the QSR segment, again not you'll not find any large blue chip company there. So a balanced portfolio, higher proportion of large caps, you can say a 60-70%, and a 30 to 40% weightage in mid and small caps. That should do for a 3 to 4 year kind of a portfolio horizon.
So that I also want to get in your view on the primary markets. Of course, 2021 has been a stellar bumper year for IPOs. But what happened with Star Health IPO, we've seen, right? So if you could give us a sense of a trend perhaps that you've seen, especially when it comes to the retail investors and them getting more and more used to and more comfortable with uh, IPOs and knowing what to subscribe, what to stay away from, and where to jump on the IPO frenzy and the IPO bandwagon. Talk to us about what the recent trends or the recent data has thrown up in terms of primary markets and retail investor.
Yeah, yeah. So I think Karuna, you rightly came to a very interesting segment, IPOs, which general investors like very much, and especially in the current year where we have seen the maximum IPOs so far, where the amount raised, the funds raised through IPOs have crossed 1 lakh crore. That is highest so far, and we have seen the highest fundraise in Indian history. So Paytm raising more than 18,000 crore surpassed Coal India, which was the highest fund raised in India so far. So it was a very interesting year for IPOs, and we saw a lot of new age companies coming up with IPOs and getting a lot of market interest. But I should really congratulate the Indian investor community that we just don't get carried away by the IPO flows. And we have seen a market rejecting companies with either bad business models or low profitability or high valuation. For example, you took the example of Paytm, where the valuations and the business profitability, despite it being a well-known name backed by a lot of investors, it did not get that kind of response from the market post listing. And similar was the story with Star Health, a business of being in the a very good business of insurance. Despite that, the valuations were not comfortable, despite it being backed by a lot of marquee investors. So market clearly is looking at the each offering individually and separately, and not just going by the flow of the market, that you get anything in the bull market and it will get subscribed and you will get a premium listing. So it also, what it does is that it makes investors sit and look that just because it's a well-known brand or it's a well-known name and backed by marquee investors, I will invest and I will make money within a week by on the listing day. You really need to work hard to understand the business model, the long-term growth prospects, the valuation, more importantly, at which the company is coming with the IPO. So I think that's a very good trend that Indian investors are showing. Just because there is a flow of IPOs, it doesn't get subscribed and it doesn't get that kind of premium listing.
Okay, makes sense. Another big development that the street will be watching out for next week is the RBI's MPC meet. Up until now, the central bank has been maintaining an accommodative stance. They've kept the rates low as well. What do you expect will happen next week? Will there be a meaningful revision?
So I don't think RBI is in a position right now to revise their outlook, or at least do anything specifically in terms of rate. See, generally, if you look at what RBI does, we follow what the global markets and especially the US Fed does. There are talks of US Fed already started off the tapering, but the hiking interest rate is still some time away. The cause of basic concern was the commodity price led inflation, which was impacting the global economy as well. But with the new wave of pandemic, with the new wave of coronavirus, I think the central banks across the world will hold on to that interest rate for some more time to see if there is any impact on the economy this time around as well. So I think the RBI will maintain a status quo as of now. That is what the best assumption right now is.
So that's some more viewer questions are trickling in. This is also related to the BFSI segment. One of our viewers wants to know how the insurance sector is likely to perform in the coming years. There's been a lot of claims because of COVID, right? We had spoken to the LIC chairman also last month, and he said that most of the claims have been settled, and going forward in the second half, the growth will be solid. But overall, if we look at the currently listed space, the insurance private sector players, how do you see them faring over the next few years? Now that even LIC IPO will be, launched very soon in the next few months.
Yeah, so I think if you take the insurance space, has seen some pretty interesting times in India. From a purely not listed space, some 3 4 years back, we saw a whole host of them getting listed, and now the big daddy LIC coming with its IPO as well. So it's a welcome change from being a department of the government to becoming a corporate, and then also coming to the on the public space. So we'll get a lot of data information about their financials, the workings, which definitely will be a positive step for the capital market as a whole, where you'd see a lot of people participating in the IPO because of the sheer size that it will have. Coming to the view on insurance, I think the insurance companies have done really well over the past couple of years. We've seen insurance penetration in India increasing, especially on the life side. See, on the general side, there some of the products are mandatorily insured. Some of the you can say awareness has helped improve, specifically in the health insurance space, and the pandemic has only helped people, the insurance people to be able to increase the awareness, the benefits of our insurance does. So we are very positive on the insurance space, both the life as well as non-life. The life space, there was some impact, and because of the pandemic, they have seen some decline in numbers. But I think the India penetration of insurance is pretty low. Even the people who have bought insurance, the coverage ratio is pretty low to what global standards are. And that is one product where it's if you see the use of insurance is almost like 100 years ago also we had insurance. The disruption has only happened in the way we buy and sell the insurance product. So the need for insurance is always there, and these companies are being using technology to innovate and distribute. So overall, we have a very positive view. We feel that next 2 3 years, the growth rate will only accelerate from here. In terms of valuation comfort, we like something like a Max Life Insurance, where we believe that the change in the management is only helping improve growth, followed by a company SBI Life. ICICI Pru and HDFC were positive, but the stocks had already moved up, and the valuation is a bit on the higher side. On the general side, we have the ICICI Lombard, ICICI General Insurance, which one can look at from a long-term investment perspective.
Okay, all right. We're already in the last month of this year. This year, if you look at the big trends, of course, it belongs to a great extent to themes like primary markets, IPOs, and of course, the metal space. But going forward, if one were to ask you, what will be the one sector, or maybe two also, if you have, to watch out for 2022, what sector will you be closely watching out?
So as I said, Karuna, on the blue chip side or on the large cap side, IT is a space that we really like. We believe that space or that the sector has room for strong growth, and with the strong order book order inflows that they have seen this year, I think the consistent delivery on the business will only increase next year. So that is one sector that I think people should look out for. And the some of the other sectors, if you ask me, that we would be looking at, as I said, the capex theme is something that can really do well. And so cement, capital goods, and real estate club together in that capex theme. That is the space that should really do well in 2022.
All right, Siddharth, it was a pleasure chatting with you. Thank you so much once again for sharing your insights on a host of developments and themes to watch out for. Thank you and have a great
My
weekend.
pleasure. Thank you. You too.